Now let's go over the indirect method. And as I said before, the indirect method is widely used compared to the direct method. And the reason is because it's easier to prepare. And even if you prepare the direct method, you'll have to reconcile it with the indirect method. But if you do that with the indirect method, if you prepare the indirect method, you don't need to reconcile it with anything. You only reconcile it with the cash balance in the balance sheet. So the indirect method reports cash flows from operating activities by beginning with the net income and adjusting it for revenues and expenses that do not involve the receipt of cash or payments of cash. One thing I want to remind you is that the direct and the indirect methods are only apply to the first section of the statement of cash flows, which is the operating activities section. So how does it work? So as you can see here, the cash flows from operating activities, it starts with net income, and then we adjust the net income to get the net cash flows from operating activities. So how we do that? We make just some simple adjustments by referring to the amount of change in the balance sheet. So we'll see how this works in the coming slides. So the adjustment to reconcile net income to net cash flow from operating activities includes such items as depreciation and gains or losses on fixed assets. So changes in current operating assets and liabilities, such as accounts receivable or accounts payable, are also added or deducted depending on their effect on cash flows. So the idea behind the indirect method is that we bring the net income from the income statement, and that's our starting point, and that's why we see the net income here, and that we work on some adjustments so we can remove the accrual part of the net income and leave it with the cash part. So that would leave us with the cash flows from operating activities. So in other words, we get the net income and we clean it from the accrual revenues and expenses. And we only focus on, or we leave the cash and the cash revenues and the cash expenses. So it's a smart way of relying on the income statement to prepare the statement of cash flows. The primary advantage of the indirect method is that it reconciles the differences between net income and net cash flows from operations. Because the data are readily available, the indirect method is less costly to prepare than the direct method. As a result, the indirect method of reporting cash flows from operations is most commonly used in practice. So here is a comparison between the direct method and the indirect method. In the direct method, you can see that we have the cash received from customers, and these are considered to be cash inflows, and that's why it's a positive value. And then we subtract from it the cash payments for expenses, and these are negative values. And we get the net cash flow from operating activities. In the indirect method, we do it differently. We get the net income, and then we make some changes and things like current liabilities and current assets, and we get the net cash flow from operating activities. One thing I want you to be aware of, whether we go direct or indirect, the bottom line values should be the same. So there's no difference between the net cash flow from operating activities if we're using the direct method or the indirect method. So these are two methods of presentation, but they're not two methods of calculation, because your calculation at the end should match, should be the same. Now let's talk about cash flows from investing activities. And cash flows from investing activities show the cash inflows and outflows related to changes in the company's long-term assets. I want to stress on this. The focus of the investing activities section is the long-term assets. So cash flows from investing activities are reported on the statement of cash flows, and just to make it clear for you and straightforward, we only use direct method in the investing and the financing activities section. But in the operating activities section, this is where we have the choice to go either direct or indirect. But when it comes to the investing activities, it has to be direct. So as you can see here, we have the cash inflows from investing activities, and then we subtract the cash used for investing activities. So cash inflows from investing activities normally arise from selling fixed assets, investments, and intangible assets. The cash outflows normally include payments to purchase fixed assets, investments, and intangible assets. So it's the same thing that we're spending on or we're receiving money from, but if we receive it because we're selling it, then it's an inflow. If we are buying something, so we're spending cash, so it's a cash outflows. Financing activity, which is the last section of the statement of cash flows. The cash flows from financing activities shows the cash inflows and outflows related to changes in the company's long-term liabilities and stockholders' equity. Remember, example for long-term liabilities could be changes in notes payable, changes in bonds, and stockholders' equity, it's any kind of issuance of preferred stock or common stock, or if we're paying dividends, or if we are purchasing treasury stock, all of that would fall under financing activities. So cash flows from financing activities are also prepared using the direct method, and they're reported on the statement of cash flows as follows. So we see here cash inflows from financing activities minus the cash used for financing activities. Cash inflows from financing activities normally arise from issuing long-term debt or equity securities. So for example, again, as I mentioned before, issuing bonds, notes payable, preferred stock, common stock, all of these creates cash inflows from financing activities. Cash outflows from financing activities normally include paying cash dividends, repaying long-term debt, or acquiring treasury stock. Now let's talk about a very special scenario, which is the non-cash investing and financing activities. In many cases, a company would exchange a land for a stock. So these are two major, like we have here, a stock, which is equity, and the land, which is an asset, and cash was not involved. But if we think about it, these were two transactions that normally would involve cash. So what we do is that we just include a footnote to the statement of cash flows explaining this kind of non-cash exchange between investing and financing activities. So as you can see here, it says a company may enter into transactions involving investing and financing activities that do not directly affect cash. For example, a company may issue common stock to retire long-term debt. Because such transactions indirectly affect cash flows, they are reported in a separate section that usually appears at the bottom of the statement of cash flows. It's just a brief explanation to explain that there is a non-cash investing and financing activities. Very similar to a footnote. It's not actually a footnote. Maybe I said a footnote, but it's not a footnote. It's just the last line in the statement of cash flows. So as you can see here, an example, we have the statement of cash flows where it has its three sections: operating, investing, and financing activities. And we get the change in cash, and we add it to the change at the beginning of the period to get the cash at the end of the period. And then at the very end, at the very bottom, like it's very similar to a footnote, we just say non-cash investing and financing activities are equal to this value. Another thing that I want to stress on is that we don't use something called cash flow per share. I hope you remember we use something in the income statement called earnings per share. But when it comes to the statement of cash flows, we don't say cash flows per share because it might create some kind of confusion for the shareholders. However, we can definitely calculate it if we wish. So cash flow per share is simply cash flow from operations divided by the number of common shares outstanding. Cash flow per share should not be reported on a company's financial statement for a couple of reasons. One of these reasons is that users may misinterpret the cash flow per share as the per share amount available for dividends, which is not the case. And users may also misinterpret cash flow per share as equivalent to or maybe better than earnings per share, which is something we don't want to send as a message to the shareholders because remember, the income statement is prepared based on the accrual basis, so we have to present the earnings per share based on the accrual basis. So cash flows from operating activities, the indirect method, this is something that we need to spend some time on. In the coming slide, or in the coming video, I'll be going over this in more details.